In this video, I will show you how I actually pick stocks that outperform over time. I will give you specific criteria that will definitely help you if you want to pick winning stocks for your stock portfolio. So the first thing I screen is the stable free cash flow per share growth over 5 or 10 years, not just earnings per share of revenue. Okay, let me explain how it goes. You have different metrics that are important when you consider an investment, right? What is really important, and that's maybe the step one, is this a growing business, a profitable business that is growing? So you can check the revenue growth, but revenue growth will not indicate the profitability. You can check earnings per share growth, that's a very good indicator, but you can do even better. And the top one indicator I have for screening great stocks is the free cash flow per share growth. You take the free cash flow of the company, you divide it by the number of shares, and you have plenty of websites like Stock Unlock or FinChat to track the free cash flow per share of the company. There is a great correlation between free cash flow per share growth and stock prices growth. If your free cash flow per share is growing 20% per year, there is a great chance that the stock price of the company will go up by 20% per year in the very long term. You can compare it with many companies in the very long term, meaning 10 or 20 years. You have a great correlation between these two metrics. So I would say that's the top one element. And this is why it's the first point of today's video. I don't want to waste your time. Please screen for stable free cash flow per share growth. Stable meaning you want this to be above 8%, depending on the kind of returns you want actually. Don't shoot for the stars, don't put something above 20%, but maybe if you want to have a good filter, a good screener, you can put a free cash flow per share growing 10% or more for the past 5 years, 10 years. The longer the time horizon, the better the predictability. So you want to do this for 5 or 10 years minimum, you can even do 20 years. If you have a company that has grown that free cash flow per share for 10 years by 15% per year for the past 10 years, there is a great chance they will continue to do that in the future. The past is a very good indicator in the future when it comes to investing. So you want to check if the company has been consistent in the past, because they will continue to operate like this. It's very unlikely that the business will drastically change. If they are not disrupted, they will continue. So the higher the free cash flow per share growth, the better it is for your returns. So that was for the first point. You can check this. And if you do this, if you have a threshold of minimum 15% growth for the free cash flow per share, you eliminate 90% of all the companies, because this is very rare to have these golden opportunities, these golden companies. And this is the reason you outperform. This is the reason why I outperformed for all these years, because I'm very picky about the stocks I choose for my portfolio. And free cash flow per share growth is a very good indicator of this. Second point, I discard 90% of ideas in 5 minutes using automated filters and strict thresholds. I already told you about the revenue growth, net income growth, earnings per share growth, free cash flow per share growth. You can eliminate a bunch of companies. And you also have key filters to eliminate the bad apples. For example, a company filled with debt will not go through my filter. So how do I pick outperforming stocks? I only focus on companies that don't have a debt or cash problem. I want companies without a lot of debt, that are filled with cash, generating strong free cash flow that is growing over time. This is the perfect scenario, and not a lot of companies fit these criteria. Not a lot of companies are like this. And another tip that I can give you completely for free is to be a harsh grader when it comes to companies. In the investable universe, you have more than 50,000 companies. So you have a lot of stocks that are publicly available. You want to fill your portfolio with 10, 15 stocks out of 50,000 stocks. So you have plenty of choice. If you spend some time analyzing a mediocre average business, you have wasted your time. You could have used this precious time to analyze great businesses that compound at 15% per year. So be a harsh grader, be picky, be selective to find the best opportunities, because this is the reason why I outperformed and generated a performance above 20% per year, because I just say no to 90% or even 95% of all the investment ideas that come into my area. So this is really, really important. Next point, I check for capital allocation discipline, buybacks, return on invested capital, ROIC, and reinvestment rate. Okay, now you are focused on, imagine you have done a quick selection of companies that are profitable, growing their free cash flow per share, they don't have a debt problem, they are fairly efficient, you understand the business model. Now, the next step to only pick the 1% is to check the capital allocation decisions of these businesses. What is that? How does it work? What does it mean? Capital allocation is the most important part of being a CEO of a company. Once you have generated cash flows for your company, what do you do with the cash? Either you repay the debt, or you give a dividend, or you reinvest inside the business, you reinvest in yourself like Amazon, or you do a buyback program here. Buyback is you repurchase your own shares. Depending on every scenario we have in the universe, a recession, inflation, a competitor coming fast, depending on all the different scenarios of life, the capital allocation decisions will change. A CEO that is good at capital allocation will do their best to maximize the free cash flow per share value of the stock, the free cash flow per share. So you want to track if over time, over the past 5 years, over the past 10 years, the CEO of a company has done great things to improve the free cash flow per share, whether it's dividends at some time, and then at sometimes buybacks, and then reinvestment, it depends. But what is great is if you are disciplined with this process, everything is for free. We live at the age of the internet, ChatGPT. You can ask ChatGPT these questions. How did the management react during 2008? How did the management react during the pandemic in 2020? Did they do a lot of buybacks? Did they stop the dividends? Did they acquire another competitor? This is quite good. I mean, you have the information for free and in a couple of seconds. Use this to your advantage. We have plenty of data. In the 80s, it was not like this. So back in the days, it was not as easy to check the capital allocation discipline. And what I want to avoid, and this is also why I outperform, I avoid bad capital allocators. Because sometimes you will have great companies in a great industry and terrible capital allocators. And terrible capital allocators will destroy shareholder value, will plummet the stock price. It can be a great company, and then a new CEO comes, and they make a lot of acquisitions with a lot of debt, and they say there will be synergies in the future. There is no synergy. It's a complete fail. It's a complete mess. And once they have failed once, they do it again. Another acquisition filled with debt. You will have plenty of examples like this. So be careful of this. This is definitely a red flag and you want to stay away from these businesses. As always, be a harsh grader. Please be a harsh grader. Be very cautious when it comes to capital allocation. It's very important. And to the contrary, you have management teams that have been great with capital allocation for the past 20 years. They know how to do dividends. They know how to make an acquisition. They know when to do the buybacks. They know how to improve the return on invested capital, the ROIC, like above 20% every year for 20 years. So sometimes it's that simple. You just focus on the great management teams and it will make your life easier, less stressful and easier, and you will outperform the market. Next point. To outperform the market, what I have done is to only focus on sectors, industries that I can understand, that are inside my circle of competence. So understandable sectors with predictable cash flows and pricing power. So we have already talked about the predictability of cash flows. You want something that grows every year very well with efficiency, and pricing power. Pricing power is the ability for a company to increase their prices without customers complaining, without churn rate. For example, the iPhones are expensive. They have been raising their prices for many years, but still, if my iPhone breaks tomorrow, I will buy another one. I don't care. The price is up, is more, that's fine. Okay, I will buy more. So Apple has an amazing pricing power. Same thing for Ferrari. Or Ferrari, they can increase the price of 10% per year and customers will be fine. Same thing for Netflix. Netflix has been raising their prices every year for the past years, and this is fine. Customers are still here because they see the value in Netflix. They enjoy it. They will not unsubscribe from Netflix. This is going fine. So in my portfolio, I only have companies with predictable cash flows and pricing power. So this is the ability to raise your prices. And if we are going into an inflationary era for some reason, the costs will increase and you need to offset this inflation with higher prices. So Ferrari will not be impacted by inflation. Netflix will not be impacted by inflation. Apple will not be impacted by inflation because they can raise their prices and pass on the cost to the customers. And on average, these companies with pricing power have better free cash flow per share growth. So better stock prices growth over time. This is how you outperform. Next point. Once I have done the analysis, my own filters, I compare against top investors' portfolios. For example, if I'm interested in a company, I check who of the best investors of the world, who owns this company. And if Chuck Akre or Terry Smith, if they own this company, I read what the best investors have to say about this company. Pretty simple. You can just type the name of the company on the internet, like Netflix, Chuck Akre, and you check if they have said something. Or you can go to websites like Dataroma to see who owns the I can show you actually. You can go to Dataroma here to check who owns which stock. I can show you if you go to Netflix, this company, you see who owns Netflix. Tom Russo, Pollen Capital Management, Viking Global Investors, and Lee Ainsley, Maverick Capital. Very well. You can type these names on the internet, read their comments, public letters. They will talk about Netflix. They will explain, okay, we like Netflix because of this and this and this. And in terms of analysis, it will highlight the threats, the dangers, the competition, the advantage. You will have a better understanding of the stock. And this is also why you invest in an understandable sector. You want something that is inside your circle of competence. So you want to understand the company very well. You want to understand the sector very well. This is how you outperform. You are in your niche that you know very well, with a great business, a great management team, and you have the best investors in the world backing you, backing the investment thesis. So you have a confirmation bias here, but you want to confirm the idea because great investors own it. And if it happens that no big investors own this company, so be it. You can skip this point. That's okay. That's just a plus. That's just an additional benefit of being in the same team as these big investors. Let me continue. Now let's talk about valuation. How do I buy companies to outperform the market? Now that you have created a watch list of great companies, great capital allocation, wonderful, valuation is really important. I track valuation bands, like the multiples, PE ratio, what has been the PE ratio over time, and only act when price drops below fair value by 30%. I want to buy not at a fair price, but I want to buy with a margin of safety. This is really important. If you think that a company is worth $100, maybe you don't want to buy at $100. You want to buy when the stock is dropping at $70, at $50. So you have a discount. You have a $50 discount. You buy with a margin of safety. and it's reassuring to have this. It's more secure and it reduces the risk in the investment thesis. So you only buy at a discount. You want to avoid the situations when you pay a premium with the company. That's how you make stupid mistakes. So 1, you pick the best companies. 2, the best sectors. 3, the best management teams, best capital allocation, best predictable free cash flow, and 4, the best valuation. The best valuation, and you need to be patient. And once you have a discount, a margin of safety, this is when you buy. You don't buy when stocks are elevated, high, expensive. You buy when there is a discount. This is how you find the best deals. You have great discounts and you can make a lot of money if you buy at this point. This is what I've been doing for almost the past decade. Let me continue. My picks are not based on hope. They are based on reputable business performance. Yeah, exactly what we preach on this YouTube channel. We want to check businesses, if they are good, if they are efficient. So the strategy is not based on hope. This is based on fundamentals, real stock picking with real companies. And if this is the level of clarity you want in your portfolio and you want some help to find the best winning stocks for your portfolio, I've helped over 200 people use this exact method. You can book a free strategy call below and let's make your portfolio work like it should. If you have difficulty doing it for yourself, I have a coaching program. There is a link in the description below. You can book a call with me. It's completely free and we will discuss your investment portfolio. We will discuss what are your objectives, what are your worries, your problems, your issues, and we will implement a strategy that works for you so you can outperform the market. So click the link in the description below, book a call with me, and I'll see you on the other side.